Okay, let's unpack this. Imagine a colossal engine that has powered global growth for decades, seemingly unstoppable, suddenly sputtering. What if this slowdown isn't just a minor hiccup, a temporary dip we can ride out, but something deeper, a fundamental deep-seated shift in how the world's second-largest economy operates? You've provided us with a stack of fascinating insights from, well, articles, research, your own notes, and today we're diving deep into the intricate and sometimes, yeah, concerning economic reality of China.
It is fascinating, isn't it? Because we're looking at a nation that has just fundamentally reshaped global trade, technology, geopolitical dynamics, now grappling with challenges that seem far more structural than temporary. This isn't simply a post-pandemic rebound thing, not at all. This deep dive will systematically explore why China's long-standing, incredibly successful growth model is now running out of road. We'll look at the critical frictions, the vulnerabilities it faces because of that, and what Beijing is doing, or maybe more importantly, what it's not doing in response.
Right. So our mission today is to arm you, our listener, with a clear, nuanced understanding of the why behind this really significant economic deceleration. We want you to grasp what this means for the everyday lives of millions in China, their job prospects, their ability to buy a home, and crucially, how these shifts could ripple across the globe, impacting everything from, say, your investment portfolio to the price of stuff in your local store. Think of this as your essential shortcut, really, to understanding a complex, evolving story, complete with hopefully surprising facts, practical takeaways, and enough depth to make you feel properly informed.
Exactly. And to guide us through this, we've structured our deep dive logically. We'll start with a concise overview, a sort of big picture look at this structural shift. Then we'll delve into 6 notable cases, specific core frictions that are really challenging the system right now. From there, we'll move to Beijing's current policy actions, what they're doing in the latter half of 2025. We'll dissect the tools they're using and the trade-offs involved. And finally, we'll look ahead at future implications. That includes a practical data dashboard, what you should watch next possible scenarios for the coming 6-12 months, and those potential global spillovers for markets, commodities, supply chains.
Okay, sounds like a plan. Let's kick things off with a quick summary then. The sources, they're incredibly clear on this point, aren't they? We are absolutely not talking about a post-COVID wobble anymore.
No, definitely not. That ship has sailed. It's not about things just bouncing back to normal after a disruption. This slowdown is far more profound.
It's deep, pervasive, and critically structural.
That's absolutely correct. If we connect this to the bigger picture, it's a fundamental recalibration, a re-engineering almost of the entire economic system, not just some minor adjustment. You see, China's old growth model, the one that really propelled it to superpower status, was heavily reliant on 2 main engines. Massive investment and really robust exports. And both of these, well, they've reached their limits. Across the economy, we're seeing this crisis of weak confidence, an astonishing amount of local government debt, really eye-watering numbers, and a property bust that isn't just a cyclical downturn that'll naturally correct itself.
Right, not just a temporary dip.
No. So the expectation isn't a quick bounce back, that V-shaped recovery we often hope for. Instead, we're looking at a prolonged period of, well, grinding adjustment is a good way to put it. You can anticipate selective easing measures, very targeted rescues for specific critical situations, and yeah, periodic market rallies, but they're often quickly punctuated by disappointing economic data.
Hmm.
This is not something that will correct itself in a quarter or two. It's a foundational shift in China's economic trajectory.
So, okay, to use an analogy then, we're not just talking about needing a quick oil change for a car that's running a bit rough.
Not at all.
Think of it more like a high-performance race car engine. It
Yep.
used to run on super high-octane fuel, always accelerating, always breaking speed records. Now imagine that engine is suddenly running on, I don't know, a much lower-grade fuel, maybe even contaminated fuel, and it needs a complete, complex overhaul, not just a quick tune-up.
Yeah, that's a good way to put it.
It's fundamentally changed its performance characteristics. The power output, the acceleration, the whole driving experience is different because the engine itself needs to be re-engineered, maybe even replaced, to function effectively in this new environment. That isn't temporary. It's about the core mechanics.
That's a perfect way to put it. And that re-engineering, that structural shift, that's precisely what we need to understand. Because for 2 decades, China's economic miracle was largely driven by what you could call a build, build, build mentality. Just massive, relentless investments in housing, local infrastructure, and expanding its export capacity. This was the undisputed blueprint for their incredible historic growth.
And that model worked incredibly well for a long time.
It did, and it was predicated on several interconnected factors. First, you had rapid urbanization, hundreds of millions moving to cities, creating huge demand for housing, roads, everything. Second, rising household incomes, fueled by new factory jobs, entrepreneurial spirit. And third, incredibly easy access to credit. That lubricated the entire system, fueling both construction booms and, a growing consumer class.
Hmm.
This strategy delivered historic gains, absolutely. The world's
Right.
second largest economy, lifted hundreds of millions out of poverty, an unparalleled achievement. But
There's always a but.
there's always a but. As with any high-growth strategy pushed to its absolute limits, it also created significant imbalances, vulnerabilities. And those are now, unmistakably, coming home to roost.
Okay, so what were the main pillars of that old model that are now crumbling?
Right, the pillars that once seemed unshakable, infinitely scalable, they've hit their limits. Let's break it down. First, you had property as the primary savings vehicle. This is huge. Ordinary Chinese households poured sometimes up to 70% of their wealth into homes. They saw it as a guaranteed path to security, prosperity.
A safest bet.
Exactly. Developers then, they pre-sold units, often way before construction even started, using that cash to finance their next massive project. And local governments were deeply tangled up in this. They sold land use rights to these developers to fund infrastructure, public services. It created this symbiotic but ultimately very fragile ecosystem that relied on property prices always going up. Always.
Right. What was the second pillar?
Second, we saw this intense period of credit deepening. State-directed finance actively pushed investment into all sorts of sectors, sometimes even when the returns on those investments were clearly diminishing or maybe even negative.
Well, lending money even if the project didn't really make sense long term.
Pretty much. It led to massive overinvestment in many areas, manufacturing capacity, infrastructure that maybe wasn't strictly needed or financially viable. It was growth for growth's sake, fueled by cheap, easy loans.
And the third.
Third, there was an extraordinary export intensity. This really buffered many of China's internal imbalances. Essentially, external demand from global markets soaked up China's domestic overproduction. So even if China was building more factories, making more stuff than its own people could possibly buy, it could just export the surplus. That kept growth going and masked some of the underlying inefficiencies at home. Worked brilliantly for decades, but now it's showing its cracks.
And by 2025, I mean this year, this once unstoppable machine is showing clear, undeniable signs of strain. New apartments aren't automatic wealth generators anymore. That whole perception, that guarantee, it's faded. Lower-tier cities especially are critically oversupplied, empty buildings, unfinished projects. And developers who were once these titans of industry, they're now struggling just to stay afloat, right? And crucially, to actually finish the projects they already sold.
That's absolutely right. And the direct consequence, households feel significantly poorer. They're much more cautious about spending. That sense of wealth accumulation through property, it's reversed into wealth destruction for many. So they're saving like crazy, up to a third of their income sometimes as a buffer against uncertainty. For firms, meanwhile, they're heavily discounting just to move inventory. That's severely eroding profit margins everywhere.
And policymakers are caught in a bind.
Completely. They're in a profound dilemma. Stimulate too much, and they risk big pressure on the yuan, their currency. Plus, you get moral hazard bailing out bad behavior. But stimulate too little, and they risk this low nominal trap.
Okay, that low nominal trap sounds particularly nasty. Can you break down what that actually means? How does it feel for ordinary people?
Yeah, it's insidious. Imagine your salary only goes up by, say, 1% a year. Maybe it doesn't go up at all. Meanwhile, the cost of living isn't really moving much, maybe even falling slightly in some areas. Your real purchasing power isn't growing. And any debt you have, your mortgage, whatever, it feels heavier because your income isn't keeping pace, even if the amount you owe stays the same. So you feel poorer, less secure. You delay buying a car. You put off renovations. For companies, if prices are falling, their revenues shrink, their profits shrink. They're less likely to invest, less likely to hire. It creates this vicious cycle. Weak demand leads to falling prices, leads to lower incomes, less spending, which feeds back into even weaker demand. That's the trap. An economy where even okay-ish growth feels weak because prices and incomes aren't rising. Makes it incredibly hard to pay down debt or feel like you're getting ahead.
And beyond that, you've highlighted how fundamentally unbalanced the Chinese economy is, especially that consumption versus investment piece. It sounds like a huge structural disconnect.
Oh, it is, absolutely. And this is a critical point the sources really hammer home. A recent analysis, I think it was from the University of Gonan, found that back in 2019, household consumption was only 39% of China's GDP. Just 39%.
Wow. Compared to what globally?
Well, the global average is around 60%, and in places like the US, it's closer to 70%. But in China, contrast that with investment. Investment was a massive 41% of GDP in 2023. The global average is just 23%. This fundamental imbalance means China inherently produces far more than its own population can consume, which leads inevitably to these persistent trade surpluses and this continuous structural need to export its surplus goods, which, as we'll get into, is now causing major friction globally and making Beijing's job even harder.
Right. Adding to these internal dynamics, you mentioned the external pressures, like the new U.S. tariffs announced by Donald Trump back in April 2025, targeting China, the great rival. Feels like more than just a trade spat.
It does. And internally, you can't forget the impact of zero COVID. That policy, lasting 3 years, created this period of pretty unprecedented isolation. It contributed hugely to a significant decline in foreign investment. Multinationals faced massive uncertainty, supply chain chaos. It also hammered domestic demand, lockdowns, restrictions. People just weren't spending. Businesses weren't investing. And the ripple effect was a big rise in unemployment, particularly worryingly among the youth. We'll dig into that. Just look at the growth figure for 2024, 5%. That was the lowest in 30 years. A really stark contrast to the double-digit rates they used to boast, like almost 14% in 93 over 14% in 2007, shows you just how much things have changed.
Okay, that gives us the big picture, the structural shift. Now let's zoom in. Let's get into the specifics where these issues are really hitting home, causing friction. Our sources identify 6 core points, right? 6 areas challenging the system, shaping the lived reality for millions.
Exactly. And the first friction, well, it's arguably the most significant, the property bust. This sector, long the seemingly invincible engine of the economy, once accounted for, get this, 30% of GDP. And maybe 20% of all jobs, directly or indirectly. But it became this unsustainable bubble, fueled by cheap, easy bank credit for massive construction projects that often just outpaced any real underlying demand. It was a speculative frenzy.
And the sources keep bringing up Evergrande, a name everyone knows now, unfortunately. They point to that project in Zhejiang, Jiangsu province, the ghost city. Rows of empty, unfinished buildings, such a vivid, chilling image of oversupply.
It really is. And it's a prime example of the kind of unchecked overconstruction that became so common. For years, developers, backed by easy credit, assuming prices would rise forever, just built like crazy. President Xi Jinping did try to curb it in 2020 with the 3 red lines policy, basically trying to limit credit for indebted developers. That was the signal. But by 2021, the bubble, already stretched thin, burst. Evergrande, with over $300 billion in debt, was eventually ordered to dissolve in 2024, left countless construction sites abandoned, unfinished projects all over the country, and millions of homebuyers in limbo. Their life savings just tied up in homes that weren't built.
And the impact on ordinary households. It's profound. People had nearly 70% of their wealth tied up in real estate, thinking it was the safest bet. Now, prices have plummeted 30–40% in big cities like Beijing, Shanghai. That's staggering.
Yeah.
Devastating.
It is. And it creates what economists call a wealth effect in reverse. Instead of feeling richer as property values rise, people feel significantly poorer, often quite suddenly. This crushes big-ticket consumption, delaying car purchases, appliances, and it kills new mortgage demand. Even though the government's offered incentives, lower down payments, easing restrictions, there's this huge credibility gap. People are hesitant. They won't buy until they really trust prices will stabilize and, crucially, that projects will actually get finished. Especially outside the big top-tier cities. They've seen too many ghost cities, too many broken promises. It's not just economic, it's a deep psychological blow. Rebuilding that trust, that'll take years, maybe decades.
Which brings us to our first knowledge gap, doesn't it? What are the long-term psychological impacts of such a massive loss of household wealth on a national scale? It feels like something that could change attitudes for a generation.
Absolutely. It fosters deep-seated caution, maybe a permanent shift away from aspirational spending towards just saving for security. Property viewed with suspicion. Economic decisions driven by fear, not ambition. It's a profound shift to track.
Okay, so friction number 1 is the property bust.
Yeah.
And it's not just homeowners and developers hurting, is it? It's hitting local governments hard too.
Leading to friction number 2, local government and LGFV debt.
Correct. With property markets so weak, land revenues, which were often the main income source for local governments, sometimes over 40% of their income have just shrunk dramatically. This severely strains their budgets, their ability to fund schools, hospitals, basic city upkeep, and then you have the local government financing vehicles, or LGFVs, this whole layer of hidden off-balance sheet debt.
Right, LGFVs. Can you simplify what those are? Sounds a bit like clever, but maybe risky accounting. That's not a bad way to put it. Think of LGFVs as special companies set up by local governments. They borrowed money, often for huge infrastructure projects, roads, bridges, industrial parks. But crucially, it didn't appear directly on the government's official books, a way around central borrowing limits. The really problematic part. They often borrowed short-term bank loans, shadow banking products to fund long-term illiquid projects, creating this big maturity mismatch.
Borrowing for 1 year to fund something that takes 20 years to pay off.
Exactly. Like borrowing for 1, 2 years to fund projects that might take 10, 20 years to generate returns, if they ever do, required constant refinancing, just kicking the can down the road perpetually.
And the scale of this debt.
Staggering. The IMF estimates provincial and city debt, including these LGFVs, top 60 trillion yuan, that's about 7.8 trillion back in 2023. Take a province like Guizhou, one of China's poorest. They were pushed into massive infrastructure spending. Think of a multi-lane highway in some remote mountain area built for industrial parks that never really took off. That project, likely funded by an LGFV, is now underused, generates zero revenue, but carries this huge debt burden that the local government implicitly backs. Huge, often unsustainable debt for these regions. Little hope of repayment.
And this debt isn't just a government problem. It bleeds into the financial sector, right?
Right.
Potentially hitting banks.
Precisely. Regional banks, especially, are extremely exposed to LGFV and developer debt. Now, Beijing is orchestrating quiet rollovers, extending repayment terms, and doing some targeted swaps to ease immediate stress. But these measures, they just manage existing liabilities. They don't stimulate new demand for loans or kickstart economic activity. It's like managing chronic symptoms without curing the disease. The system's still burdened. They're just shifting the burden, buying time, not creating new wealth, to really fix the underlying problem of too much debt tied to unproductive assets.
Okay, on to the third core friction. And this one sounds counterintuitive. Deflationary pressure and weak nominal growth. Prices actually falling. That sounds good, but it's a huge problem.
It is. It's a classic economic trap, absolutely. When firms struggle to sell stuff weak demand, fierce competition, they cut prices to clear inventory. Seems good for consumers short term, maybe, but it eats into profit margins for businesses, and it significantly cuts tax receipts for the government. But crucially, when consumers and businesses expect prices to fall further,
They delay buying things, wait for a better deal.
exactly, they delay purchases, delay investments. This slows down the velocity of money in the economy.
Right, the velocity of money. Can you explain that impact a bit more?
Sure. Think of it like this. Money isn't just sitting still. In a healthy economy, it's constantly moving spent, earned, respent, flowing quickly. If people delay purchases, that money isn't flowing as fast. It's like traffic slowing down on a highway. Even if there are lots of cars, the overall movement is sluggish. Goods aren't getting where they need to go efficiently. This slowdown means fewer transactions, less economic activity, and ultimately a weaker economy.
So even if the real GDP growth number looked okay, maybe 5%, the lived reality, stagnant wages, shrinking profits feels much weaker.
Exactly. This is where ignoring nominal dynamics is so misleading. Wages, company profits, tax revenues, the actual money people and governments feel and spend depend on nominal growth, which includes price changes. So if prices are falling, even with 5% real growth in volume, the nominal values are much lower. This makes real GDP numbers feel very weak on the ground. It directly hits disposable income, people's sense of economic health, their willingness to spend, a big disconnect between official stats and daily life.
The human cost really comes into focus with the fourth friction. Youth, unemployment, and skills mismatch. This is really concerning socially, too.
It is, and it raises important questions about social stability, about China's future potential. A staggering 17% of young people unemployed, nearly 1 in 5. You've got this massive wave of university graduates hitting a job market where the private sector is just incredibly cautious. Still reeling from past regulatory crackdowns on tech, online education, entertainment, key hiring sectors. Many of these young people are highly educated, high aspirations, but facing really limited opportunities.
And there's a mismatch, too, between jobs available and skills.
Yes, precisely. While China's rapidly building capacity in specific high-tech areas, EVs, batteries, solar place, these capital-intensive industries don't absorb the huge number of service sector graduates. Many are trained for roles in education, finance, internet services, sectors that have either shrunk due to regulation or become hyper-competitive. These weak job prospects create this devastating confidence loop. Their insecurity depresses their spending, delays marriage, forming households, stifling the very consumption needed for recovery.
And compounding this is demographics.
Oh, hugely. China's population started shrinking in 2023. India's now overtaken them. Decades decades of the one-child policy mean the population is aging rapidly, profoundly. You see places like Rugao, 1.4 million people with 525 folks over 100 years old, 78,000 over 80. Nationally, 1 in 5 Chinese is now over 60. That puts immense strain on underfunded healthcare pension systems, and it hits the workforce directly. Projections show 250 million fewer workers by 2050, a demographic time bomb limiting future growth, burdening a shrinking working population.
Okay, friction 5 takes us global. Trade, tariffs, and overcapacity. China, the workshop of the world, leader in EVs, solar, but now facing headwinds.
That's right. Beyond Trump's tariffs, you've got broader de-risking by Western nations, slower global growth generally, all hitting China's export volumes and prices. And internally, this leads directly to a big problem: overcapacity.
Right, overcapacity. What does that mean exactly? Sounds like too much of a good thing, but clearly isn't.
It means China's producing way more goods, EVs, solar panels, batteries, steel, you name it, than it can sell domestically or export sustainably without wrecking markets. This leads to brutal price wars inside China, companies slashing prices just to gain share or offload inventory. Now, this is good for global buyers wanting cheaper green tech, sure, contributes to global disinflation. But it's incredibly tough on Chinese producers, their suppliers, erodes margins, makes long-term planning impossible, an internal pressure cooker.
But interestingly, the sources note China's been quite resilient in redirecting exports, finding new markets despite U.S. tariffs, Europe, Southeast Asia, Latin America.
That's true, yeah. And it has helped offset some declines to the U.S. But there's a limit. Other countries aren't indefinitely economically able nor politically willing to just absorb China's vast surplus without pushback. We're already seeing new protectionist measures. The EU's 17.35% tariffs on Chinese EVs, citing subsidies. Turkey slapped a 40% tariff on EVs. Brazil, Chile putting tariffs on Chinese steel. So redirection is a short-term fix, but it often just creates new trade frictions, new barriers globally, complicates that export model further.
Okay, so with all these challenges piling up, property, debt, deflation, unemployment, trade issues, overcapacity, why isn't Beijing just unleashing a massive stimulus package like we've seen elsewhere, or even in China's past?
Right.
Which brings us to the 6th friction, policy handcuffs. Are their hands tied?
This really raises an important question about the constraints they face. There are significant policy handcuffs at play, yes. For instance, big sweeping interest rate cuts the obvious stimulus tool risk, putting huge pressure on the yuan, affecting FX stability, potentially causing capital outflows. They also further squeeze bank net interest margins, which are already under pressure from all the bad debt. Plus, big unconditional bailouts. Well, they risk moral hazard.
Moral hazard again. Explain Beijing's worry there. Why not just rescue everyone?
Well, the worry is, if you bail out every struggling developer or local government that made bad bets, you send a signal that risky behavior will always be forgiven. It's like letting a kid always get away with breaking rules. They learn there are no real consequences. They'll likely do it again. Economically, it encourages more reckless lending, more bad investments in the future, makes the underlying problem worse. So Beijing wants to avoid setting that precedent.
So they're opting for a more cautious surgical approach, not the broad brush.
Yes, exactly. A very clear preference for precision tools over bazooka stimulus, targeted mortgage easing, funds specifically for finishing existing projects, not starting new ones, selective fiscal support for key strategic sectors. It's very different from the massive stimulus packages we saw elsewhere, or even China's response in 2008. And the political economy matters too. Since Xi Jinping came in around 2012, state-owned enterprises, SOEs, became a much stronger pillar again. 12% of jobs, maybe 25–30% of output, with party cells inside to ensure compliance. So while they talk about opening up, supporting private firms, regulatory control has visibly tightened. Look at Jack Ma, founder of Alibaba, forced to step back. So they're constantly balancing economic needs with tight political control, ideological alignment. It's delicate.
Okay, maybe time for that second analogy.
Yeah.
The ship in the storm.
Right, yeah. China's economy is like this massive container ship in a severe storm. The captain, Beijing, has tools. But the engine is weakened by these structural issues. You've got high winds, global protectionism, giant icebergs, all that debt. They can't just full throttle their way out. They have to steer carefully, make small, precise adjustments, repair critical parts one by one, manage the crisis surgically, not try some risky, broad maneuver that could capsize the whole ship. It's controlled navigation, risk management.
So how are all these frictions, this conscious response?
Yeah.
How's it manifesting day to day? What does this new normal feel like on the ground for households?
For households, it's this pervasive shift towards caution. frugality. They're actively trading down cheaper brands, delaying big purchases like cars, appliances, holidays. Crucially, they're building up cash buffers. Saving like mad is a safety net, not spending. And property. It's seen as a home first, risky investment second, a huge shift from before. Job stability, wage growth. Those are the top concerns now, just trying to hold on.
And for businesses,
Yeah.
especially manufacturers, retailers who thrived on growth.
For firms, it's intense margin pressure. Cutthroat. Widespread discounting, fierce competition, especially where there's overcapacity. Capital spending is highly selective, favors export sectors, subsidize areas like EVs, solar, batteries, other industries, deferring investments, scaling back. Many are feeling working capital strain too. Harder to manage cash flow as payments slow down. The easy growth days are definitely over. Survival of the fittest.
And banks.
Banks are feeling it too. Compressed net interest margins, lower rates, competition for deposits, much tighter credit checks for developers, LGFVs, unless there's a clear government guarantee. Harder for them to get new money. The bank's focus has shifted dramatically. It's about prioritizing project completion for existing loans, getting those pre-sold homes built, not expanding new credit lines into risky areas. They're managing risk, not driving growth.
And the developers themselves.
Yeah.
The former giants.
Painful consolidation. State-linked players are gaining share, better government ties, easier financing. Their focus, purely on delivering existing projects, trying to restore some trust, not launching new speculative ones. And for offshore stakeholders, international investors holding Chinese developer debt. Longer, deeper restructuring compared to onshore creditors, who usually have a stronger position. A harsh new reality for global investors.
Okay, which brings us to that second knowledge gap you flagged. How do these policy handcuffs, especially around FX stability, bank margins, affect China's ability to boost domestic consumption? That thing everyone says is crucial for rebalancing.
It's a critical insight, absolutely. The handcuffs severely constrain their ability to truly unleash consumption. Rebalancing towards consumption is vital, but Beijing's caution means they can't just flood households with cash or slash rates dramatically. Both actions risk currency blowouts or destabilizing banks further, so it's this challenging paradox. The very measures needed to boost consumption are limited by the financial stability worries stemming from the old model. They need to transition, but they can't fully use the obvious tools for it. Very tricky.
Okay, so given all these challenges, these constraints, what is Beijing actually doing here in the latter half of 2025? What tools are they using? What are the trade-offs? Let's get into current practices.
Right. Well, earlier in 2025, we did see some targeted monetary easing, lowering the loan prime rate, the LPR benchmark, cutting the deposit reserve ratio, the DRR, freeing up bank funds, other liquidity tools too. However, lately, there's been a distinct preference to just hold steady on rates because they're balancing that FX stability, keeping the yuan steady with protecting bank profitability. Those policy handcuffs we talked about, they can't just keep cutting rates without consequences.
And the property market. Are they trying to prop it up fully, reignite the boom? Or is it more subtle?
Definitely not a full prop up to reignite a boom. That's crucial. It's more about relief measures to stabilize the market and, importantly, ensure social stability. So they're doing things like lower down payments for buyers, relaxing purchase limits in top-tier cities like Beijing, Shanghai, to boost demand in the stronger markets, and using this whitelist financing.
Whitelist financing. How does that work on the ground?
Sounds important. It is. It's a direct intervention. Local governments identify specific pre-sold residential projects that are stalled, deem them critical, then basically facilitate bank loans directly to those specific projects or developers. The whole idea is to ensure home buyers who've already paid actually get their homes delivered. So say a project in Hangzhou, 1,000 pre-sold units, half built, it gets whitelisted. Banks lend the money needed to finish it. It's not for new construction, solely for completion, to rebuild trust, prevent social unrest. There are also some incentives for first-time buyers, upgraders in select cities. But again, the goal is stabilization, completion, not reigniting an unsustainable boom.
Okay. And beyond property, fiscal support.
Incremental fiscal support. Measured injections, not a massive spending spree like 2008. So, higher quotas for special local government bonds funding priority infrastructure, central local co-funding for key projects, public services, plus targeted support for advanced manufacturing, services sectors deemed strategically important for the long run. It's all very calculated, measured steps. Calibrated, not the bazooka stimulus some might expect.
And the private sector. Over 60% of output, 80% of urban jobs. How's Beijing managing their confidence, the regulatory climate? especially after those crackdowns.
It's a very clear dual approach, can feel contradictory sometimes. On one hand, guidance against disorderly competition, price dumping things Beijing sees as bad long-term. On the other hand, lots of messaging to bolster private sector confidence. Promises not to reverse reforms, not to overregulate. But it's that tightrope walk. Because, as we said, SOEs get stronger post-2012. Party cells inside ensure compliance. Regulatory control tightened look at Jack Ma. So balancing that tight political control with encouraging real private innovation investment, it's a constant delicate challenge. And trust, slow to rebuild.
And behind the scenes.
Lots of quiet, intricate balance sheet work. Case-by-case restructuring for struggling developers. LGFVs. Not broad bailouts. Measured support for regional lenders addressing specific problems without signaling a full rescue. The key takeaway here is crucial. Beijing aims to stabilize the slope of adjustment, manage the decline, the gradual rebalancing, in a controlled way, not reverse it overnight back to the old model. It's about a controlled descent, a redirection, not hitting the brakes and trying to reverse course.
Okay, so looking ahead then, what should we as informed observers be watching for? What are the key indicators, the practical data points that tell us how this story is unfolding?
Right. This raises an important question for you, our listener. To stay properly informed, here's a practical dashboard of data points to keep a close eye on. First, watch the PMIs, Purchasing Managers' Indices, gauging manufacturing, services, health. Is manufacturing still below 50, indicating contraction or recovering? Is the services sector, which was stronger, starting to ease? Second, keep a close eye on home price indices, new and resale. Are the year-on-year falls slowing? Does any stabilization in Tier 1 cities spread to the lower tiers, the ones really struggling?
Okay, PMIs, home prices. What else?
Third, credit and total social financing data, the overall lending picture. Any sustained pickup in household mortgages, medium long-term corporate loans, that signals confidence returning. Or are people still shying away from new debt? Fourth, critical social indicator, youth unemployment and job postings. Do those seasonal spikes around graduation fade or persist into autumn? That signals deeper structural problems. Remember that 17% figure, critical number to track. Fifth, policy cadence. Look for subtle LPR-DRR tweaks, changes in special bond quotas, city-level rule changes on property purchases, down payments. The devil's in those details.
Like for the property sector itself.
Yeah. Sixth, watch the developer workouts, acceptance rates for restructuring plans, actual delivery milestones for unfinished projects, and crucially, recovery values onshore versus offshore stakeholders. Who's bearing the brunt? How fair are the resolutions? And finally, overarching all this, FX and capital flows. Yuan stability, portfolio flows. These are key constraints on Beijing's ability to ease further. They can't afford a major devaluation or capital flight. These factors dictate their room to maneuver.
Okay, that's a great dashboard. Now, our sources outline 3 possible scenarios for the near future, right, for the next 6-12 months. Helps contextualize the data.
Exactly. First, the most likely path, the base case. Managed muddle-through. Expect mixed data, sporadic upticks, frequent disappointments. Property remains a drag but should gradually stabilize first in top cities. Project completion drives sentiment more than new launches. Policy stays targeted. No bazooka. The main risk. Confidence rebuilds slowly. Nominal growth stays subdued. The lived reality feels stagnant.
Okay, that's the base case. What's the more pessimistic view?
Scenario 2, Japanification light. Here, deflationary tendencies persist, become entrenched. Households keep saving heavily. Corporate investment stays super cautious. Weak aggregate demand lingers. Market rallies sparked by policy news. They fade quickly. Underlying earnings stay soft. Income growth elusive. The risk is that low nominal trap becomes protracted, makes debt harder to manage over time, similar to Japan's long stagnation after its bubbles burst.
And the optimistic scenario?
Scenario 3. A bolder stabilization push. This would mean bigger, more direct central government support for project completion. Broader, more significant rate cuts, fiscal easing. Explicit backstops for regional banks to shore up the system. The upside. Faster turning confidence. Broader property floor beyond just Tier 1 cities. But the risks are much higher. More FX pressure on the yuan, increased moral hazard rewarding bad actors, weaker bank profitability. Beijing knows these trade-offs, which is why they've been cautious so far.
Right. And finally, what's all this mean for the rest of us? For the world? Markets, commodities, supply chains?
Yeah.
The global spillovers?
There's significant, definitely multifaceted. First, manufacturing prices. Cheaper green tech from China, incredibly cheap EVs, solar, batteries, puts intense price pressure on Western producers. Creates a powerful disinflationary impulse globally. Good for consumers getting cheaper stuff, maybe, but tough on domestic industries in Europe, North America, potential job losses, factory closures.
What about commodities?
For commodities, demand from China will be noticeably softer than in past growth cycles. This supports global disinflation, keeps commodity prices in check. But it also caps major commodity rallies. Bad news for producers in Australia, Brazil, the Middle East, maybe.
And supply chains. Everyone's talking about diversification.
Yeah, for supply chains, diversification efforts will continue, more production shifting to ASEAN, India, Mexico. However, China's sheer scale, its mature infrastructure, its deep industrial ecosystem, incredibly hard to replicate quickly or cheaply, full decoupling, a very long way off.
And markets.
For markets, emerging market Asia risk sentiment will closely track China headlines. Global PMIs, freight rates, they'll respond directly to Beijing's policy moves, the health of China's economy, sensitive barometers of global activity.
Which leads us to that final knowledge gap, the third one. Given these global spillovers, cheaper Chinese goods, softer commodity demand creating disinflation, how might this influence central banks in the U.S., Europe, their monetary policy decisions in the coming year?
It's a huge question with global implications, yeah. Will they see this as helping their inflation fight, allowing them to ease more aggressively? Or will new pressures emerge, maybe from trade tensions or something else, forcing a different response? A complex dynamic, no easy answers at all.
Okay, so what does this all mean for you listening? We've unpacked China's complex economic slowdown, moved beyond just a post-COVID blip to a profound structural shift reshaping its future. We've seen how that old growth model, property exports, has hit its limits, leading to huge frictions, bursting bubbles, overcapacity, local debt, youth unemployment.
And we've looked at Beijing's measured, targeted responses, aiming to stabilize the adjustment, not reverse it overnight with a bazooka. The lived reality reflects this. Caution dominates household spending, intense margin pressure for businesses. As you track those PMIs, home prices, credit data we mentioned, remember this is a multi-year adjustment, not a quick fix. A careful, deliberate dance between stability and structural change with global ripples.
And here's where it gets really interesting. A final provocative thought for you to ponder. If China truly needs to boost domestic consumption to rebalance its economy, to avoid that low nominal trap, how fundamentally would its political and social structures need to change to actually achieve that, especially given that historical preference for investment, exports, and the tight state control we've seen? How might that internal transformation reshape its global role, its interactions with the rest of the world? It's a question that really goes to the core of China's future.
Thank you for joining us on this deep dive into, well, one of the most critical economic stories of our time. Stay curious, keep exploring these crucial insights.
We'll be back next time with another deep dive into the information that matters most to you. Until then, keep asking those big questions.